They did not only bring the cash, they brought a lot of expertise and inputs to the startup that made the founders world-class CEOs or leaders within their organizations, and eventually they became a multi-billion companies. Hi, you're an entrepreneur and you have an idea, and now you're ready to build your own startup. And you're thinking about the different sources of funding your startup. And you look at other companies and you may notice that they're riding a rocket ship and they're growing very fast. There are many factors that can impact the growth of any startup company. But funding specifically has a huge impact on your startup. As a matter of fact, it can alter the outcomes of your entrepreneurial journey. So in this video, I'm going to discuss different aspects about funding and what are the different sources. And we're going to discuss also what is actually a funding for a startup, and what defines a good funding and what defines a bad funding, and how can you make the different trade-offs as you decide throughout the different stages of your journey between a good funding and a bad funding. So let's dig in. So let me start with a very basic question, which is, what is funding for any startup company? Many entrepreneurs think of funding as an exchange of money for an equity in your company. And this is a very limiting definition of funding. You probably know that for any startup to work and become a billion-dollar startup, there are many factors that need to work together. Yes, funding is a critical aspect of it, but you need to look after smart money, not just any kind of source of cash. And as a result of that, the right definition, the proper definition of funding is cash in exchange of partnership, not only equity. And that's why whenever you look or think about where to get the money for your startup, you need to think about the right stage and the right milestone where you need to raise your money. Who are you raising the money from, and why are you raising the money? So we're going to talk more about these and about the sources, but it's important to know, first of all, why and what is funding. So now the next question is, what defines a good source of funding? Now, as I mentioned, funding is not only about cash. It's cash plus a few other things that would help you in your startup journey. And what defines a good funding depends on what you need at that specific stage where you are raising money. So for example, in the early stages of your startup where you're trying to validate your product or your idea, it's important to get cash and also introductions to potential customers. In later stages, it's important to get cash and get the talent that would allow you to scale and grow your startup. So the cash is not the only factor. What defines a good funding, again, is what you get on top of the cash. Now, to the last question before I dig into the different sources of funding. Do we really know some companies that selected specific kinds of funding and made a big difference in their journey? Yes, absolutely. There are many, but let me maybe pick a couple of examples. Airbnb and Dropbox, they both graduated from YC or Y Combinator. And Y Combinator is a very known accelerator in the Bay Area, and it provides a lot of support in addition to the basic cash or the initial cash that they inject into those startup companies. It helped them with lots of introductions to enterprise customers in case of Dropbox. It helped them with a lot of the logistics that they needed to figure out when, in case of Airbnb, when they wanted to scale their operations. So they did not only bring the cash, they brought a lot of expertise and inputs to the startup that made the founders world-class CEOs or leaders within their organizations, and eventually they became a multi-billion companies. All right, now you may ask me, okay, Mo, what are the sources of funding that I can get for my startup? Now, other than bootstrapping your startup by yourself or getting loans, there are some other ways known in the startup world that you can get cash in return of equity and, of course, the rest of the partnership elements that we discussed earlier. And these are 6 sources. Number 1 is friends and family. The second is angel investors, crowdfunding, accelerators, VCs or venture capitalists, and finally, private equity firms or companies. I'll explain each one of them briefly and help you decide which one of them is the right source of capital for you to either kickstart your company or take it to the next level. Now, the first source of funding for your startup is friends and family. And this is one of the earliest sources of funding. It's really pre-seed. You just have an idea and you would like to validate this idea. And they usually fund you out of trusting you and seeing a high potential in you and your idea. And actually, there are really famous examples out of this kind of family and friends funding. Google, actually, founders were able to collect $1 million from their close friends and family to get the company off the ground. The same happened with Microsoft and Facebook. And you'll notice that there's a common thread among those companies. They're high in risk, they're mostly R&D, or they could be nerdy projects without clear business outcomes at the beginning. Obviously, they just gave them the money because they trusted the founders. And there are some pros and cons actually behind getting this kind of funding. Let's start with the pros. It's relatively easy to get this source of money, and it's quick. And there's no enough due diligence required, or there isn't much of a due diligence required before they give you the money. Actually, in most of the cases, there is zero due diligence. And also, it usually happens in favorable terms for the founders. Your friends and family, again, they trust you. And they just want their money back and maybe some sort of a markup on top of that. Now, the disadvantages or the cons out of this kind of funding, if it's not clear to you and to your family members that they may lose their money, some relationships can really go bad as a result of that. In many cases, they do not provide any kind of support. They're just giving you the money. Probably they are not even in the same space where you are, so they cannot really support you that much. So there are two tips worth sharing here when you tap into this kind of funding. First, be clear with everyone that there is a high chance for them losing all their money. And that's why you want to make sure that whatever the money that you're raising from them is not going to hurt their financials significantly. And second, augment whatever money that you're raising from them with good advisors or someone who can guide you through that initial process in your startup journey, because most likely the family and friends are not going to dig into the details of your company and your startup unless you're lucky enough and one of your friends already knows the space and they're willing to help you with a few introductions or vetting the idea. Now, let's talk about the second source of funding, which is angel investors, and it's somehow close to the friends and family. Angel investors are rich individuals who are in the space or would like to be engaged with some entrepreneurs, and they're willing to invest some of their personal money into some promising founders and startups. And usually this kind of money comes with some kind of support. Those are persons who know the space probably, or they have some connections through which they can help you a lot. And usually they would invest somewhere between as low as $25K to $200 or maybe $250,000 in return for, of course, some equity in your company. Now, notable startup companies that got this kind of funding are Google and Facebook. And Facebook actually got funding from Peter Thiel. And Peter actually helped Mark Zuckerberg a lot in the company's or Facebook's early stages to scale and acquire a lot of users. And this kind of funding is considered a good source of funding when there is a specific expertise that you can get from that angel investor. As I mentioned, it could be a connection with a potential customer, or it could be some sort of knowledge, like in Facebook case, or it could be also just mentorship that you can get from those angel investors. So there's a lot that you can get from those angel investors. Now, what could be the disadvantages of this kind of funding? Number one, some angel investors are micromanagers. They stick their hands into a lot of the company business, and as a result of that, they may limit the entrepreneur's ability to explore and learn and make mistakes. And second, some angel investors actually the other way around. They don't do anything. And you need to be really careful with that as an entrepreneur. And usually you would ask about any angel investor before getting any source of funding from them. Now, the third source of funding is accelerators, and accelerators are considered the MBAs for founders. And accelerators work in a way that they bring a group of companies in one cohort. They incubate them for 3 months, and during those 3 months, they get them into a series of meetings and mentorships and sessions to educate the founders about how to validate their product, sell it, build a prototype or the MVP of your product, and make it ready to be a business. And at the end of that 3-month period, they have a demo day where they bring a lot of VCs and they prepare the founders to present and demo their products. And out of that days, many founders get good funding ground for their companies because those 3 months truly accelerated the path of those companies. Now, notable accelerators in the Bay Area are Y Combinator, 500 Startups, and there are a few others. And there are big companies that came actually out of those accelerators, like Dropbox and Airbnb. And those accelerators help those companies to truly accelerate their journey and have a great start of that company. And we all know about those companies. They're public companies now out of just an initial idea that was incubated by YC or Y Combinator. Now, the fourth source of funding for your startup is what everyone hears about, which is venture funding or venture capitalist. And venture capitalists, by the way, they work pretty much like startups. They go and fundraise for their firm and they have a certain thesis. And if the startup company match the thesis and their criteria to select ideas, they fund you at the end. Most venture capitalists offer cash only, but when it comes to really the respected VCs, the tier 1 VCs in the Bay Area and other parts of the world, they do not only provide capital. They provide capital and, of course, the support that we talked at the beginning of this video, like connections to customers, connections to talent, and sometimes even the VCs would support you in your operations of your company. And the VCs also can cover all the stages of your company. There are VCs for seed or pre-seed, and of course for A and B and C and D. I'm going to talk in a different video about the different funding stages and how you should plan your startup funding. But VCs in general become a good source of funding when you now need more cash and you need some basic support out of that cash. And the other sources, it's more, especially the accelerator, is all about getting the support. This is more valuable for you in the early stages. But as you progress in your journey, now you need cash to scale what you already mastered and what you already know. Now the question here is, when do VCs become a bad source of capital for you? Obviously, number one, if you do not provide any kind of support, I wouldn't recommend that. Number two, if you do not want to give a lot of control of your startup company, because usually when you fundraise from VCs, large amounts of cash, you give them equity in return, and of course you give them lots of control. They need to be on the board and they can make big decisions for the company. Third, if you do not really want to work by the VC terms, most VCs want their startups to move really quickly and double their value and double their business every 12 to 18 months. Some founders do not really like that style of doing business. They want to go a bit more slower because they want to build certain foundations for their company. And finally, some VCs would add a lot of pressure on their founders when their fund reaches the maturity stage. For VCs, they have to return the money with, of course, the return of that investment to their limited partners. And if you're towards the end of that fund, they may add a lot of pressure on you to sell the company or liquidate their equity in the company, which may hurt the entrepreneurs in different ways if those goals do not match the timeline that the entrepreneurs have in mind. So the fifth source of funding is private equity. And private equity has some similarities with venture capitalists, but they work shorter term. They do not take as much risk as the VCs would take. They fund you for a very specific goal, like going to the public market or IPOs, or preparing the company to be sold, or preparing the company to be profitable. So there's a very specific business goals that most of the PEs would fund, startups for. And of course, the drill. PEs also, there are two types of them. Some of them would come with support, and this is the majority of them because there's a lot of money that they will invest in you. And some others would just be mostly passive. They just connect with you every 3 months to get the numbers, and then they would disappear. PE becomes a good source of money if you need a ton actually of money for your startup. You're in the late stage, D and beyond, and you're preparing for that big exit. PEs will become a really good source of that. If you really would like to make your company or take your company to the enterprise level, being an IPO or work with really huge and big customers that would require a lot of cash to be injected into your company to fulfill those big projects, then a PE would become a good source. Now, when would a PE funding become a bad source for you? Of course, you wouldn't approach the PEs in the early stages of your company. They're a good source only when at the late stages. If they have certain mandates that you would not accept for your business, then you should definitely run away from them. Like, you have to sell the company by that specific date, or you have to give them certain control of your board that probably you do not want to give at this point, or you have to take the company into a certain direction that you did not want the company to go to. Maybe that would slow down the company or would be too risky for you and for your venture. They're mostly business objections, but they're modeled pretty much like the VC model. They would fund you with almost the same terms. Now, the sixth source of funding is crowdfunding. And crowdfunding is relatively new and is an innovative idea that allows a common person to invest in your company in return for either an equity or an early release of your product. And notable platforms in this area is CircleUp, Indiegogo, or Kickstarter. And actually, there are two projects worth mentioning that came out of crowdfunding campaigns. The first one, probably you heard about, is Oculus virtual reality headset. Yes, it's the one that got sold for $2 billion to Facebook. They wanted to raise $250,000 and they were able to achieve their goal in less than 4 hours. Another one is Tile, which is that little piece that you attach to your keychain and it reminds you where you left it the last time. And they were also able to raise their goal fund in less than 24 hours. Now, you'll notice that there's a common thread between those companies. First, those companies are targeting B2C, and this is what those platforms are built for. And second, it's for products that are easy to demonstrate and easy for others to get the value of and fills a gap that everyone almost recognizes. Now, it becomes a very good source of funding when, yes, obviously you have a B2C product and you would like to generate some initial demand before developing anything in the product. Another really nice and interesting thing about this source of funding is it imposes on entrepreneurs the fact that they need to work backward. So they have to think of the product, show it in a clear value proposition, and work backward from that point. Now, when this kind of funding become a curse or something that is not really suitable for you, if you're building B2B, obviously it's hard to get a campaign on any of those crowdfunding platforms. And second, if you want to really be secretive about your product, it's not possible to do it over any of those crowdfunding platforms without inviting others to copycat you. It's easy for others to see your idea, and you have to be really confident about your ability to deliver the product quicker than everyone else that could be copying you. So let me leave you with 3 main points that hopefully will help you to decide about what would be the best source of funding. First, ask yourself, why do you need the money? Do you need the money right now to validate, or do you need to accelerate, customer acquisition, or there's another reason for that? And it's important also to take a look at yourself. What kind of blind spots you have and what gaps do you have in your skill set? So for example, if you're a first-time founder and you are coming from a technical background like me, then you'd probably need to join an accelerator and learn a lot about the different business aspect of your startup. How do you validate the product? How do you do the marketing? How do you do initial sales and so on? And the second point is think of a future milestone. What kind of achievement you want to have 1 year or 2 years from now, and then work backwards from this. So for example, if you have an idea and you know the problem that you would like to solve, and in 1 year from now, you're planning to have 10 customers, this is a good milestone. Think from that point. What kind of skill set, what kind of guidance do you need? And then focus from that point on selecting the right source of funding that would help you to cover all those needs and reach that milestone. And finally, regardless of the source of funding that you decided to pick, you must know all of them. What is not good for you today might be good for you tomorrow. And also, your funding should have a roadmap. Not an exact roadmap, but you should have some sort of a rough idea. You're going to start with friends and family, and then maybe you're going to join an accelerator to learn some of the business aspects of building a startup. And then after that, you might go to a VC. Maybe you're going to get stuck. So you may go to crowdfunding, or maybe things will go well. And then after that, you are going to tap into private equity when you reach advanced stages of your entrepreneur journey or your startup. So it's important to know all those options and plan that ahead. Otherwise, you will be just wandering around and you will be just accepting any cash that comes to you. And that's the worst thing that can happen to you in your entrepreneurial journey.